to our class. Learning objective 2 introduces you to financial ratios. Ratios are, as you know, from not just math class, but maybe even your English class. Didn't Shakespeare write something like ratio, wherefore art thou ratio? Maybe I misunderstood. Maybe I'm blowing it out of proportion. Get it? Or maybe just a fraction of you will understand that joke. Okay, so enough math jokes today. But ratios are really just a relationship of two numbers. When we look at financial ratios, we are looking at basically the financial health of the company. The numbers tell us a little bit about, in this case, you're going to be introduced to a profitability ratio. Has the company been profitable for its owners over time? We're then going to look at liquidity ratios. Does the company have enough cash or can get its hands on enough cash to pay its bills? Liquidity is about getting your hands on cash fast to pay your bills. And your solvency ratio, solvency is to make sure that you're able to pay your long-term debt and stay in business. There's a lot of companies that get into too much debt, can't pay it back, and they become insolvent, which means they are out of business because they can't pay their bills, including their debts. And so ratios help us understand the health of the company area by area. Now, one particular ratio doesn't mean anything. Like anything else, it's the big picture, okay? So think about when you go to the doctor for a checkup, the doctor is gonna have a bunch of their own ratios. They're gonna take your height-weight ratio, called BMI, they're gonna look at your blood pressure, they'll look at maybe your blood work to see about your cholesterol and other types of things that are going on with your blood. All those ratios are analyzed by the doctor to see if there's any part of your health that needs to be focused on and improved. Well, just like the doctor does that with the patient, a financial analyst, an accountant, other folks that have looked at this will use financial ratios to evaluate a company's health, see where it's very strong, see where it needs some help. And so this is meant to be an introduction to that. Please pay attention. Okay, drugs are bad. Okay, so again, 3 types of ratios we're going to be looking at. Profitability ratio. Who's interested in profitability ratios? Well, who's interested in the success of the company? The owners, right? Because the profits of the company belong to the owners. We know that, right? So profitability ratios are very, very important to owners and investors. Why is it a bad thing for a company to have too much liquidity? I will get to that. Yes, I will definitely get to that. Well, the next ratio, liquidity ratios, again, every time a company has expenses. They have payroll, they have rent, they have utilities, they need cash for inventory if they sell goods. You need cash to do everything. That's why they always say cash is king. You need cash to do everything. So liquidity ratios measure the company's ability to turn certain assets to cash so they can do things, okay? And so to Terrell's point, liquidity ratios help us understand if a company is able to pay its obligations right now and whether it actually can provide to get cash if it has things coming up. So liquidity is really key, and I think that's what makes companies like Apple, Google, and Microsoft very strong companies, is that they just have a ton of cash. So they can take care of all of their bills with the cash they have on hand. They can do investments, they can buy companies, they can improve their fixed assets, etc. So liquidity is very important because without cash, you really can't do stuff, can't pay bills, you can't buy certain things that you need, can't make certain investments without the cash. And solvency ratios, again, measure the company's ability to pay its long-term debt. And all companies have some type of long-term debt. So we're going to look at each of these. In order to, by the way, in order to figure out the profitability ratios, right, you have to figure out whether the company has had a profit. So we look at the income statement to measure our profitability ratio. This is the income statement for Best Buy. It gives you side-by-side statements here, the 2013 information for Best Buy regarding its revenues and expenses are listed in the far right column. The most current year for the statement that's given, 2014, revenues are provided here. Total expenses are provided here. And here, because the revenue number is larger than the expense number, they had a profit listed here. In 2013, just the opposite happened. Their revenue number was smaller than their expenses. So they had to pay more to keep themselves in business than they sold to customers, leading to a loss of 441 here. Now these are in millions of dollars. So even though it says 441, it's actually a loss of $441 million. And even though this just says 532, it's actually a profit of $532 million for that year. So just as we talked about in chapter 1, whose profit is it, right? Who owns the profits of the company once they report their profits? Well, the owners, right? Well, you can also look at it in the same way when a company reports a loss. If a company loses money, it's the owner's problem. They benefit when the company is profitable, but they have to decide whether to cover the loss. If owners cover losses, then the company continues. If the owners cannot cover the losses, company goes out of business. Okay, and that's basically the bottom line with that. So I'm going to focus for the sake of our discussion here with profitability. Let's focus on 2014. Okay, they had 42. Now these are in millions, so you'd have to add 6 zeros. They had $42 billion in revenue. That's a lot of sales of electronics for Best Buy. They have total expenses of 41, well, almost 40, yeah, $41.8 billion. So they have more revenue than expenses by this amount. That's why it's net profit. That's why it's our profit. If you're a shareholder, you're an owner. Of course, you're not the only one because large corporations have millions of shares of ownership. So how much of this $532 million profit is yours for your share of ownership? Well, that's what the first ratio tells us. They look at the earnings. Remember, the word earnings means the same as profit, right? Retained earnings, retained profit. So what's the amount of earnings, profit, per share of ownership, what we call EPS, earnings per share. And it basically measures if the profit of the company was divided equally among all the shareholders. This is what each share of ownership would have earned as that profit. So again, I'm going to focus on 2014, where they actually did have a profit. Notice that the number of shares, which are in millions as well, fluctuate through the year. At the beginning of the year, Best Buy had 338 million shareholders. But by the end of that year, they had 347 million shareholders. And that's because companies can choose through the year to sell more shares of stock to raise money. They can also buy back stock, which is what you see here in 2013. They started the year with 341 million shares. They ended the year with 338 million shares, less shares. Well, that's because the company went out and bought stock back in most cases. Okay, you'll see that share reduction. Well, let's focus here. To calculate your earnings per share and understand this ratio, we're really looking at the profits of the company, which is a net income, divided by the common shares outstanding. Preferred dividends is a concept that if the company has preferred stock, again, we've been basically talking about common stock, but there's another class of stock called preferred stock. Preferred stock has no voting rights, unlike common shareholders, which have voting rights. But preferred stockholders get paid a dividend first before the common stockholders can share in any of the profit. And the issue is that only about 7% of companies have preferred stock, which means out of every 100 companies that have stock, only 7 of them will have also issued preferred stock in addition to common stock, which means that in 93% of the cases, this number is always going to be 0. So you're looking at basically the profit of the company divided by the shareholders. We take the average, which is the beginning amount of shareholders, plus the ending amount of shareholders divided by 2. And when you do that for 2014, you have a $532 million profit divided by roughly about 342.5 million shareholders. That means that each share of ownership would have earned $1.55 of this profit. So if this $532 million was broken into individual shares, each share would get $1 or would have earned $1.55 of the profit. Okay. This is just a measure of profitability. It's a measure of profitability. And what they like to see is that over time, that the company is obviously earning more profit, so the net income is growing, and that the earnings per share is growing. Okay, so every single quarter, every single year, there's higher profits and there's higher earnings per share. Now, if you were a stockholder in a company that had higher earnings per share, you would expect that your share of ownership is worth more value over time. And that's what makes stock prices go up most of the time. It's an imperfect science in finance. But most cases, stock prices are tied to how profitable a company is. And so stocks that tend to have higher share prices would be looked upon as stocks that have higher profitability. Okay, stocks that have very low stock prices would tend to be associated with lower profitability, lower earnings per share, if they had earnings per share at all. And so this is just a measure of profitability. I want to bring out a company that you're familiar with, McDonald's, and maybe you've been to the Golden Arches at one point in time in your life. But from the 1960s, probably the mid-1960s, to the mid-1990s, every single quarter and every single year, McDonald's would report higher revenue, higher net income, profit, and higher earnings per share for basically every single quarter for 30 years. That's amazing. That's amazing. They hit a wall in the 90s, late 90s, forgetting who they are, with the McPizza, mix other crap that they put out there. But they're back on track. They're back on track, thankfully, because we're in 2020. But for a long time, McDonald's was an earnings machine. They always put up more stores that sold more product, that led to more profit, that led to more earnings per share. And it was like clockwork, just you could always count on it. Microsoft was that way for a while as well. Apple has been that way for the last for the most part for the last 10 plus years. Earnings per share is a big reason. Well, one of the biggest reasons you want to be an investor in a company is you'll see that it's more and more profitable over time. So your share of ownership is more profitable over time because it's sharing in the earnings over time. So this is just an example of how to calculate earnings per share. Again, it's the net income of the company. So here, this company, Stoneland Corporation. Maybe they sell marijuana. Stoned land, I don't know. They have net income of $26,000. Again, it's a textbook. Sorry, they paid preferred dividends of $2,000, and they have 6,000 shareholders. So, if you were a shareholder, what amount of the profit would be yours per share? Well, again, it's net income minus preferred dividends, which, like I said, in 93% of the cases is zero, divided by the shares. And that meant that if the profit was divided up among all the shareholders, each share would get $4 of the profit, earnings per share. For the liquidity and solvency ratios, we need the balance sheet, specifically the classified balance sheet. Well, why? Well, because we're going to be looking at total current assets, and we're going to be looking at total current liabilities. So for the year 2014, the accounting year ending 2014, you'll see that Best Buy had, again, this is in millions, so they actually had $10,485 million of current assets. Remember, current assets are listed in liquidity order, and these are liquidity ratios that we're looking at. So cash and being able to turn things into cash is an important part of liquidity. Well, why would they need the cash? Well, to pay their current bills. That's why we look at current liabilities. And the current liabilities, right, the debts that they owe within the year, here are at $7,436 million. So we need these two numbers to do our liquidity ratios. The first liquidity ratio they introduce you to is something called working capital. And working capital is just subtracting the amount of current liabilities from the current assets. So like I said in the previous slide, Best Buy had $10.48 billion of current assets. They had $7.43 billion of current liabilities. The difference, because we're just subtracting here, the difference is the working capital. So they technically would have about $3 billion of short-term, liquidity that they could use for a lot of other things. Again, these are liquidity ratios. This is the first one. The most common one that you'll see is called the current ratio. And the current ratio is simply the proportion of current assets to current liabilities. So, and we look at it this way. So here is Best Buy's information for 2014. Let's take a look at that, okay? They had, as we said earlier, $10,485 million of current assets. That's the top number here in the formula. The bottom number, $7,436 million. So when you compare these two numbers, you get this ratio 1.41 to 1. What does this really mean? Well, they have $1.41 of current assets to cover every dollar of current liabilities. And that's basically how you would read a current ratio. The amount of current assets to the amount of current liabilities. These are the total numbers here. When they are simplified, in this case, it's $1.41 of current assets to every dollar of current liability. So these, Best Buy has more than enough current assets to cover its current debts. So they're in a pretty decent position. But they have a competitor. I don't know if you've ever been into an H.H. Gregg store. You'd have to go down to Maryland and Virginia to find an H.H. Gregg store. But H.H. Gregg is basically like a Best Buy. You walk in, looks like a Best Buy. The name on the building, H.H. Gregg. Well, in the exact same year, when H.H. Gregg compared its current assets and its current liabilities, it had a ratio of 1.68 to 1. Now, what does that mean? That means that they had $1.68 of current assets to cover every dollar of current liability. Okay, so H.H. Gregg had a higher current ratio, which means that they have a better liquidity ratio than Best Buy. However, when you look at Best Buy from 2013 to 2014, their ratio went from 1.11 to 1 to 1.41 to 1, which means that in 2013, they only had $1.11 of current assets to cover every dollar of current liabilities. And they increased that to $1.41 of current assets for every dollar. So they actually increased their liquidity ratio. They made themselves a bit healthier here. Okay, but H.H. Gregg certainly is in a very, very good liquidity position. Now, like I said, Best Buy and H.H. Gregg are basically electronics retail giants. How is the industry, when you look at all of those companies that are in the industry, so the industry set of businesses that basically do the same thing. So in this case, if you look at all of the electronic retailers, how are they doing? How's their liquidity position? Well, it's not good, because in this case, it's 0.88 to 1, which means that they only have 88 cents of current assets to cover every dollar of current liabilities. Because remember, the first number is current assets. The second number is current liabilities. We're just simplifying it to the dollar here. So 88 cents of current assets to every dollar current liabilities means that the industry is stressed. They have significant liquidity issues to address. This is a tough business. There's so much competition, number one, so you can't really raise prices. If you can't raise prices, you can't raise revenue. And your expenses can be controlled, but to what degree? This company, this particular industry is under very competitive pressures. It's not very profitable. Some companies are, some companies aren't. And you can see that. It's a very stressed industry. And this liquidity ratio of 88 cents of current assets every dollar of liabilities puts most of the industry at risk for some type of financial failure to pay a current bill. But like I said, Best Buy, doing okay. H.H. Gregg, doing better. Solvency ratios is about long-term debt, okay? Long-term debt has two things going on with it. You got to pay interest on the debt. And then, of course, you have to repay the balance of the debt when it's due, okay? And so solvency really means, can the company afford both to pay the interest on the loan and to pay the loan back, okay? Maturity is another word in accounting for due date, okay? When it matures is basically when it's due to be paid back, okay? So we also need the balance sheet for this, but in this case, the balance sheet, we're looking at total liabilities and we're comparing it to total assets. That's the debt to asset ratio. And it looks at how much debt the company has compared to its assets. Now remember, you remember the balance sheet equation, assets equals liabilities plus stockholders' equity. So in order to, if you needed a $10,000 truck, which is a small truck, by the way, but anyway, you're going to need $10,000 of financing, which is your liabilities and equity, to buy a $10,000 asset. And so, you know, clearly there's a relationship. A lot of companies borrow money to buy assets, but a lot of companies have strong stockholders' equity, and they can use those retained earnings and investment to purchase assets. This looks at the amount of assets that are basically financed with debt. Best Buy has $10 billion, $24 million in total liabilities. When you compare that to the fact that they have $14 billion, $13 million of total assets, their debt to asset ratio is 72%. What does that mean? Well, it means that 72% of their assets are financed with debt. Okay. 72% of the assets are financed with debt. Now, these are 2014 numbers. When you look at where Best Buy was the previous year, it was 78%. So bringing this number down to 72% is good for its solvency ratios. Okay, it means it's relying less on debt to buy its assets. H.H. Gregg is a major competitor. Again, it's more in sort of the South. It has a debt to asset ratio of 51%. Which means that 51%, they've relied to purchase their assets, right? They relied on debt to purchase a little bit more than half of their assets. 51% of their assets were bought with debt. Okay, now that is exceptionally strong. It's very low, in fact, particularly for this particular industry. Being a retail space, there's a lot of companies that have gone into heavy debt that couldn't get out of it. Toys R Us are one of them. Sears is having an awful time managing its debt and slowly going out of business. Same with JCPenney, same with a whole bunch of stores. They just have way too much debt. And a lot of them are closing or even going out of business. This particular industry is problematic because 88% of its assets are financed with debt. So that means for every dollar in assets that the company has, they borrowed 88 cents to get it. This industry is stressed, okay? This is a very, very high debt to asset ratio for a retailer. It's not necessarily high for a manufacturer. So if I were Ford Motor Company and I create, you know, I have a large assembly line. Most of the assets that I have are going to be property, plant, equipment. I'm going to have a lot of equipment because I'm going to rely on robotics because my assembly line is going to be highly automated. Well, robots and other machinery cost a lot of money. So Ford and other manufacturers usually rely on debt to buy machinery and equipment. So having a high debt to asset ratio, if I'm a manufacturer like Ford, it doesn't bother me too much. But what does Best Buy make? What does this industry make? Nothing. They're retailers. They sell shit. That's all they do. So to have this type of a debt to asset ratio is dangerous. It's very, very dangerous. And you're going to see, I mean, you saw Circuit City go out of business. That was another electronics retail giant for a while. This industry is under a lot of stress and under a lot of debt. And so sadly, this ratio will tell us the long-term survivability of some companies. Like I said, some debt is good because a lot of companies rely on debt to buy their assets. Like I said, General Motors is listed here. General Motors is a manufacturer, right, of automobiles and trucks and things like this that are done on assembly lines that are highly automated. So they need buildings, they need lots of equipment. You don't just buy a building for cash. You often buy those with debt. You don't buy equipment with cash, oftentimes not if you need huge assembly lines. You're often buying those with debt. So having a high debt to asset ratio for a manufacturer, like I said, doesn't bother me too much because of what they do. But for a retailer, it bothers me. All the other ones, I don't know what year these are quoted from, but all the other, look at Google, very small amount of debt, right, that they rely on to buy their assets. Okay, something that we're not discussing in the class is the statement of cash flow, but there is something called the free cash flow that's part of it. Is what a good thing? The 23% for Google?
Yeah.
Yeah, Google has its share of assets. They just have more intangible assets that they rely on than to make a living than the property, plant, and equipment, although they have that too. So the fact that they don't have to borrow a lot of money to have those assets is a good thing for them. So I would say yes. So we're not going to be dealing with the free cash flow here. We will in Accounting 204, your next class, where we look at the cash flow statement in detail. And then there's a do it exercise for ratio analysis. Again, the first ratio we looked at was earnings per share. Earnings per share, you need your net income. You subtract out your preferred dividends, and you divide it by the shares outstanding. That formula is something that's already done, right? Already provided for you, and so it shouldn't be a problem. The second ratio we looked then at working capital and the current ratio, and we need two numbers from the balance sheet: the total current assets and the total current liabilities, to compare those. Right. The difference between those two numbers is the working capital. The ratio of current assets to current liabilities is called a current ratio, right? Oh, I'm sorry. And I pressed the wrong button there. Okay, so I'm going to go ahead and erase those and stop the closed captioning. Sorry about that. And the very last ratio we looked at was the debt to asset ratio. That's the total liabilities compared to the total assets, right? So if you know your ratios, you'll know what numbers to use. And again, this is simply an introduction in this chapter. So here on the do it review exercise, they ask you to compute earnings per share for Ozone. And here they had earnings, net income minus preferred dividends divided by average shares. So they had $1 per share earnings in 2017. That's better than 2016, which was only 80 cents per share earnings. So they did better. The current ratio, the debt to asset ratio, again, the current ratio for 2017 numbers, current assets to current liabilities, 2.2 to 1, which is excellent. 2016 current assets to current liabilities, 1.60 to 1, $1.60 of current assets to every dollar of current liabilities. So strong in both years, better in 2017. Debt to asset, that's your total liabilities compared to your total assets for 2017, 30%, for 2016, 44%. So that came down, so that's also a very good sign that this company has improved their financial condition.